Welcome back, everybody. This is another episode of the No Money Real Estate Podcast, and I've got a really great conversation today. I'm actually being joined by a man named George Nast. George is an exempt market dealer. It's a securities basically type of position that he's heavily involved in fundraising with our company and for many companies. We're going to have a conversation about the evolution of registered funds investing, and we're going to get into it right after this.
Hey, my name's Ken Dunn, and I'm a real estate investor. I want to welcome you to the No Money Real Estate Podcast. On this show, I'm going to interview elite level real estate investors from all over North America, and I'm going to help you to see one thing that all successful real estate investors have in common. They build their portfolios without using a dime of their own money. I've got a portfolio of $300 million in real estate. That includes resorts, apartment buildings, commercial buildings, and I built the entire portfolio without using a dime of my own money. Real estate is a business that anybody can get into, but the strategies that those tight real estate investors use to build massive portfolios have been kept secret for decades. Now, because of this show, I'm going to reveal them to you. So let's get started.
All right, welcome back, everybody. First, let me introduce you to George. Hey, George, how you doing, brother?
I'm doing very well. How you doing, Ken?
Not too bad. Now, George is out in Vancouver, British Columbia, but we work together extensively. We own a mutual fund trust that we're constantly raising money for our resort projects, and George's company helps us with that. And you do a bunch of stuff for us, George. You do a lot of our compliance, a lot of our reviews, and also help us collect the cash in those situations. And that's because you own a company that's an exempt market dealer. And I think let's start off by explaining a little bit about your background. How'd you get into this? What's your background? Why would you do something crazy like this? And what is an exempt market dealer?
The question of why is always an interesting one, because I can't do anything else in my life. I've sadly, or fortunately, depending how you look at it, been in financial services for over 30 years. I started out right out of university as an analyst at the Bank of Canada. I worked in Ottawa for 3 years. I then went on and became a management consultant at McKinsey & Company, serving financial services clients. And I did that for like 13 years. And then on to commercial banking career in Asia. And so by that time, I already racked up kind of 25, 30 years of financial service experience. And so when it came time to move on from that, what else could I do? And I thought the one thing probably missing in my life was something more entrepreneurial. I'm sure you discovered that much earlier than I did, but I thought it would be a great thing to do. And so wanted to move back to Canada anyway. At some point I was living in Singapore. And so 5 years ago, I came back and started Atlas One, and the rest is history. That's how I got into this.
And Atlas One is an exempt market dealer, or are you the exempt market dealer? Like, how does that all work?
That's a good question. So there's sort of two registered categories that are relevant. So the exempt market dealer is the firm, it's the company, and we are licensed by, in my case, it's the British Columbia Securities Commission, and we're registered across Canada. So Canada has a provincial regulatory environment, so you basically can passport your license and operate, across the country. But our main regulator is the BC Securities Commission. And then we have employees who actually interact with investors, do know your customer reviews, suitability reviews, making sure the investment is appropriate for them. They're called dealing representatives. And they also have to be registered. They have to be registered with the firm, i.e., Atlas One, and they have a registration with the various securities commissions as well. And those are the categories that are relevant for us to be able to raise capital for investments for projects like what we're working on with the Dunn Investments MFT.
You and I talk regularly. We talk weekly, as a matter of fact, and I want to get into talking about registered funds, but I want to stay on this subject right now, this exempt market dealer idea, because Canada is heavily regulated, as is any, first world country that you're in, where there's a lot of fundraising going on. And these regulations are designed to protect the people who are putting money into these projects. And that's kind of, I think, your biggest responsibility, really, isn't it?
Yes. Exactly. So we, think of the exempt market dealer as the sort of independent third party. I wouldn't go fully independent because, as you pay me.
Yeah, that's right.
for my services, not fully independent, but our responsibility really is to advocate for the investor. And so that really requires us to do two things. One is to make sure that the project that we're reviewing, that we're selling, we've actually done our own review on that. And so we do what's called due diligence, essentially review the project, review the offering, review the background of the sponsors, that sort of thing. And so make sure that there's no fraud, that's apparent and visible involved, and that, the projected returns make sense when we're advertising that to investors. So that's sort of the first part that we do. And then the second part of that we do is we do what's called know your client reviews and suitability reviews of the investor. Some of it is basic. We need to make sure the client says who they say they are. That's to make sure there's no money laundering activity going on. But most importantly, we will review the investor's circumstances, typically their financial circumstances, and make sure they're not overextending themselves, over-concentrating themselves. If we have an investor that, say, has $500,000 of net worth and they want to put $250,000 in one investment, we'll tell them that's not a good idea, right? Don't keep your eggs in just one basket, so to speak. So that's the kind of reviews that we would do advocating on behalf of investors. And that's how they are. We provide them a level of protection. Now, I also stress there are no guarantees. Due diligence will not catch everything. And then, if projects just run into difficulty or investments run into difficulty because of economic circumstances, due diligence will not capture that. But it does provide some ability. I'll go back to the eggs in a basket point. If instead we got that investor, instead of 250, we got them to invest 50, then that's all they've lost. They're not going to, suffer egregiously if they've lost that 50. If they would have lost the 250, that would have been a different story, right?
Well, there's something that you just kind of made me realize in your due diligence. And I agree with the point where you're saying, due diligence can only go so far because there could be environmental things that happen during the course of the project that throws the project off track that you wouldn't have any foresight on. And that's why you say there are certain things that you just have to be aware of. And there is a level of risk even in the safest looking project, if you will. But the thing that I've come to appreciate, I didn't really enjoy it while it was going on because your due diligence process is a pain in the ass for me.
Thank you.
But it has to be. It's kind of like it's a baseline that the people you're working with are generally speaking clean. They're good people. They've got their stuff together. They've got great teams together. There's a better than average chance that these projects that you're reviewing, if you sign off on the due diligence, there's a better than average chance that this project is going to succeed.
That's really it. There's two pieces. One is exactly that, is to make sure there's nothing obvious that's gonna create problems on the project, particularly background and sponsors, but also just the financials, the basics, of and because we're talking mainly about real estate and hospitality, there's certain very specific guidance in that industry, that we look at. But the other thing is also make sure that investors are aware of the risks, right? So if it's a hospitality project, we just need to make sure that the documentation shows that hospitality does have its cycles, it does have its ups and downs, and people are aware that there are risks in these sort of, of investments. So we can't get rid of those risks. Like I said, you won't get a good return unless there is some risk,
Right.
involved. But it's important that investors are aware of them before they go ahead and make their investments.
Yeah, absolutely. So we're currently involved in a couple fundraisers together. We have 3 resort projects that we're raising capital for, and we're heavily raising. We're doing a $20 million raise for our Hay Bay Resort project, which is a loan raise. So we're giving people the opportunity to jump into a loan with us with annual returns that are documented and contracted. So we're offering a 15% annual return. And what I love about this is going through all this work, it really is designed. And I feel very proud of the fact that we're really helping Canadians on a large scale, meaning that I would say almost 60% of the money we're raising comes from people's registered funds. That will make people nervous. That'll make certain types of personalities nervous. But from my perspective, I'm not nervous because I believe in the project. I know we've got an amazing team of people here and we will provide the returns. But from that person investing, I can't remember how long ago it was we had this conversation where this came up, where I said, we're taking part in an evolution here, aren't we? And we had a really great conversation. I want to just revisit that conversation because, friends, listen, if you're listening or watching this podcast and you're in Canada and you have RRSPs, RESPs, LIRAs, or TFSAs. These are all registered investment vehicles that allow Canadians to save money tax-free. So you can put money into this vehicle and you can make interest. Now, normally when you make interest in Canada, the government is going to take a piece of it. That's it's income tax. It's because it's qualified as income and you get charged tax on it. And if you make enough of it, you're going to get charged 40%. But if you do this inside of your registered funds, you don't pay any tax. Now, don't think this is truly tax-free forever, because when you take that money out in your later years, you're going to be taxed as income. But the cool thing about it is when you start taking it out later, you're going to take less out per year. And so your tax rate's going to be lower. And that's kind of the overall strategy to this. But George, let me just restate what I said a couple months ago when we were talking about this, when I had this aha moment. People have been able to invest in registered funds in Canada since the 70s. I think it was the early 70s when this idea first came along. And it started off with some really smart accountants and lawyers saying, we can do this tax-free thing. We can let people put their money in, and whatever they make inside of this vehicle, it will accumulate tax-free, and we can just charge tax when it comes out. And everybody loved it. It was a brilliant idea. And then they said, well, what are we going to let people invest in? And there wasn't really a lot of options. It was basically government bonds. It was the only thing that was available to do this when they started. So they started that. And as things evolved into the 80s, mutual funds were born. And basically a mutual fund, in the most basic definition, is an investment vehicle where an individual can take advantage of putting money into a mutual fund because that mutual fund has a product expert, has a manager that's an expert in that vertical, whatever that space is. And that person is going to take the conglomerate, all of the money, and invest it in a whole bunch of different publicly traded companies in that space and share the return with everybody. So when this first started happening, it was so successful, they said, let's let people do this with their registered funds. And when mutual funds first started happening, I remember the 80s. That's when I first started doing my own RSPs, and we were getting 12 and 14% returns with that. But over time, because of the fees, not just because of the fees or the saturation of the market. So these mutual fund advisors were becoming so successful, getting 12 and 14% returns, that they got greedy. And they said, we're going to start taking money out of this, management fees. And so then we started seeing these 2 and 3 and even 4 and 5% management fees. And now this is all disclosed to the individual putting money into it, but nobody thinks seriously about it. They just do what their bank person tells them to do. Now, as the mutual fund space with registered funds has matured and grown, it's become saturated or overwhelmed, meaning there's so many people doing it, the returns are falling. So in the last 10 years with mutual funds, returns have averaged 4, 5, and 6%. So because of these mutual fund trusts that we've launched, we now can work with an exempt market dealer and we can create an operating memorandum which allows us to make an offer to the public for people that are eligible investors, and they can take their registered funds and put it into our investment vehicle. And because we're cutting out the middleman, I believe, I love your comments on all of this, George, we're able to offer them 15%, and they're going to get the full 15%. Now, people are skeptical about it, and they say, well, how do you make your fees? I own the resort. I'm going to make lots of money when this happens, so I don't charge fees for managing people's money. And I think, George, it's the evolution. Sorry for just being long in the tooth there, but I wanted to give you that preamble so we can get some really great comments from you in this. But do you agree with me? It's almost like the evolution. I know people are really skeptical now, but over time, this will get really, really exciting for people.
The history you've laid out is exactly right. And I'll give a little bit of credit. We often don't do it often enough. The government's allowed the expansion of investable assets into this. I mean, ultimately the CRA has to sign off on, what's eligible for investing in RSPs and TFSAs, et cetera. But you're absolutely right. The traditional investments that had historically been, basically since the 80s, have been sort of equity-based mutual funds or balanced funds. And yeah, initially they were great, but then 20 mutual funds became 20,000. the market just got saturated and returns went down, and you had a lot of, as you mentioned, high fees and low performing asset managers coming into the market, generating poor returns for Canadians' registered funds. And so luckily, the government allowed the expansion of what is eligible. And I've always believed, this is actually one of the reasons why, I set up Atlas One, is that private securities, so private securities would be those that are not listed on an exchange, that are not under a public prospectus,
Mhm.
are where you can still generate what's called alpha, basically excess returns, for the public. And investments such as what we're doing, which is basically a private investment in resorts in Canada, are one of those categories that absolutely meet that. That's how you can generate the 15% type returns, is because one, we've cut out the middleman. There's no asset manager, collecting fees. But most important, you can't just go on the stock exchange and buy shares in Hay Bay or Lake St. Peter. You just can't do that, right? You have to work with somebody like yourself who sources these projects, turns them into marketable opportunities. It's going to generate revenue, and it's a great business, and make that available to what I would call ordinary people, as opposed to high net worth people who have privilege and access, which was the way it was done in the past. And that's the evolution. That's what I find amazing about what we're doing here, is that we're offering investments that would not have been available to people in the past. And most importantly, they can use their retirement accounts and TFSAs to actually make those investments.
Yeah, it's really funny how we got here, right? Like, I started to raise money for my resorts from my limited experiences, and I realized that I needed to be aligned with somebody like you, who was a securities expert and a compliance expert, basically to help protect me, save me from myself, if you will, from going astray of the rules. But then as we went through the entire process of setting up this mutual fund trust in this company for fundraising, it changed my perspective, George, because I started this saying I just got to raise money because I want to build these resorts. And it's got me to the point right now where it's almost overwhelming the good we're doing for average Canadians, that we can actually offer a 15% return and deliver on that. And we started doing this almost 2 years ago. And we've had well over $1 million under management that whole time. And we've made the payments every quarter. We've never been late making the payments. It's working perfectly, and it's really giving us an amazing chance to help people. Am I being naive thinking like this, George?
No, not at all. You're exactly right. I guess that's the real benefit of what we're trying to do here. There was always an ability to raise capital for these types of private opportunities, right? But it usually came from high net worth people, people with access, people with privilege, right? You'd go to a bunch of rich people and they would write large checks, and that's how it was done in the past. Now we can get ordinary Canadians involved, and so they can benefit from the returns that have only been accessible to high net worth people in the past.
Okay, listen, I know I've given you a lot of information, but I want to give you a real example of this. George and I are hosting a live online webinar on Tuesday night at 8 o'clock. And in that webinar, we're actually going to show you an example of a fundraise we're actually doing right now. It's for our Hay Bay Resort project. We're raising a total of $20 million. And anybody who is an eligible investor or better can participate. And here's the coolest part. An eligible investor is defined as, well, George, you're the exempt market dealer. Tell everybody what an eligible investor is.
Yeah, so an eligible investor, it's basically three criteria. You individually have to earn at least $75,000 of income per annum, or with your spouse, $125,000 of income per annum. And then the third criteria is $400,000 of net assets. So your assets less mortgages or any other debt that you would have. If you meet any of those three criteria, any of them, not all of them, any of them, then you are an eligible investor, and you'd be able to invest in any exempt offering that has what's called an offering memorandum, an OM we use in short form.
And so just so you understand that, friends, you don't have to have them all. If you make $75,000 a year in gross income from your employer, You can do this. If between you and your spouse, you make $125,000 a year in gross income, you can do this. Or you have 400 grand in assets. It's just one of those things. And here's the best part. The minimum investment amount is $10,000. So if you have 10 grand in your RSPs and you're not happy with a % return, you are crazy if you don't take 30 minutes and join me on Tuesday night at 8 o'clock. Join George and I on Tuesday night at 8 o'clock and learn about this. Here's the best part. It's a secured loan, and we're going to pay 15% per year. The minimum investment is only $10,000. So it really gives the opportunity for most people with stable jobs to participate in this. And we're offering a 15% annual return for 2.5 years. And George knows me well enough to know that when this 2.5-year term is done and we give you your initial capital back, we'll have something else for you to put it into. So you could maintain a 15% annual return, and then it starts compounding. And that's the most beautiful thing about RSPs, is that when you put that money in, as the 15% comes back every year, you can reinvest the entire amount and compound your returns to really get yourself into a better place for retirement. So with all that said, on Tuesday night at 8 o'clock, George and I are going to be on a live Zoom call, and we're going to explain this opportunity for you. It's going to take about 35 minutes. We've got a whole presentation to explain where we're going to talk to you about why we're raising this money and how it's being raised and how you can get involved in it. And if you like what you hear, then George has a team of people who will give you a free private one-on-one consultation and answer any questions you have and help you to set yourself up to do this. And so my call out to you is this. If you are building an RRSP right now, if you actually have an RRSP, a LIRA, a TFSA, or an RESP, you are saving money for the long term to give yourself and your kids a better life in the future. If you're not taking advantage of maximizing those returns and getting yourself to a 15% level every year, you're freaking hurting yourself. Why bother doing it if you're going to settle for a 6% return when there's a 15% return there? Do the math on that. Pull up a calculator right now. In fact, here's what I'm going to do. I'm going to pull up my calculator in this interview and show this to you so you can understand this. I'm going to pull up the calculator here and watch this. So let's say you start with $10,000 and you leave it in your bank and you get a 6% return. So how we figure that out on an annualized basis is we go $10,000 times 1.06. After the first year, you would have $10,600. Let's do this 9 more times. Times 1.06, 2 times 1.06, 3 times 1.06, 4 times 1.06, 5 times 1.06, 6 times 1.06, 7 times 1.06, 8 times 1.06, 9 times 1.06, 10. At the end of 10 years, you're going to have $17,908. That's how it works. That's what's happening with your bank. Now, let's do the same thing if you trust us and take advantage of our 15% offer. We're going to start with the exact same $10,000 on the screen times 1.15 times 1.152 times 1.153 times 1.154 times 1.155 times 1.156 times 1.157 times 1.158 times 1.159 times 1.1510. George, that's $40,000. The difference between what their bank is giving them 6% and what we can give them 15% over a 10-year term with just a $10,000 initial investment, it's an extra $23,000. They quadruple their money doing it with us, and they don't even double their money if they do it with their bank. Now, here's the other thing. Let's say you're following your banker's advice, and every year you're adding $5,000 to that. Now, I'm not going to do that on my calculator. That's not going to work. But the point is, if you can just convince yourself to show up on Tuesday night at 8 o'clock for 30 minutes, we'll explain exactly how this works and give you a chance to try it. George, when you put your compliance hat back on, what are some of the things that you want to finish off our time here? Because I just got people really excited, which is my job. Your job is to temper that enthusiasm. What are some of the things you want to say about this type of investing?
2 main points, really. One is, there is risk in this investment. And we'll talk a little bit about it on Tuesday night. But there is risks that are involved in this type of investment. You are doing a loan to a business. That business could run into challenges. That is a possibility. So I just want to warn people there is risk in that, and that's actually why you're generating these types of returns. Because there is a risk that's associated with that. And luckily, in the offering memorandum, there's a full disclosure, of those risks, and people should read those, before investing. And the second thing I would make is, and this is the beauty of the $10,000 minimum, Ken, is, again, don't allocate too much, into investments like this. Make sure you still remain diversified. Make sure you still have some liquidity, if you've got some short-term needs, and that sort of thing. That's part of what my dealing representatives will discuss, with investors. And Ken, I can't emphasize how important that $10,000 minimum is, because it allows people to do that, right? It allows them to allocate just, if they are even a little uncomfortable, say, well, allocate a small portion of your portfolio, right? And that way you still remain diversified. So that's sort of the compliance, message on that. It's not a message to say, no, don't do this. No, absolutely.
Just know what you're doing.
Just know what you're doing, and take advantage of the fact that, this is a great exempt, a private market opportunity with a relatively small investment amount that you can participate with some potential really great upside.
The last thing I'll say is that if you watching or listening to me right now, if you do qualify as an eligible investor, you're making 75 grand a year, you should be able to put 5 grand a year into your RSPs. And you should do that. That's where the compounding really becomes unbelievable.
Absolutely.
But what George is going to do for you is they're going to teach you how to do a self-directed RRSP. And what that means is you're going to create an account with a different bank. There are 4 banks in Canada. They're the main banks that facilitate this: Olympia Trust, Pacific Western Trust, Central Western Trust, I think, and Odyssey anyway.
Odyssey,
yeah. Check them out online. These companies allow you to do self-directed RSPs, to make your own decisions, which George's team will help you set up an account and move your money over there and give you advice on managing that properly to reach real financial goals. Once you set up your account with Olympia Trust, you can add 5 grand a year to it. You can add $50 a month. You can keep adding money to it and compound your returns. And what I love about this situation, George is a third party in every stretch of the word. And the reason I feel comfortable saying that is, even though we pay him for his help for us, he has to follow the rules, even if I don't like it. And there's times when he's pulled me back into the middle of the road when he's felt that there was a concern with some of the things we were saying in our marketing. Like, he's really good at that stuff. And he'll offer that same service to you. Him and his team will give you unbelievable advice if you want to get into the world of self-directed registered funds investing. George, thank you for being here with me today, brother. We'll see you on Tuesday at 9. I really appreciate your time, man.
Great. Thanks a lot, Ken.
All right, we'll see you guys later. Click on the link in the notes. Show up with us on Tuesday night at 8 o'clock. And do yourself a favor. Start self-directing your registered funds.